Hello, everyone, and welcome to the October WBA Compliance Corner. We're glad to be able to bring you another video here in the middle of fall, where Heather and myself update you on hot topics and happenings within compliance since our last installment back in September. So with this information, we do provide links where available as well. So as we go through the slides, remember that if something is marked with an asterisk in the presentation, there's also an associated link to go with that with separate resources and materials. So check in the YouTube video description below to find that link with the associated material on the slide. So with that, let's jump into it and take a look at what we'll be covering in this video. So just on our second slide here, we have a summary of the topics, and you can see there's quite a bit here. So I'll take us through really quick to give you a perspective and overview of what we'll be talking about, and then we can get right into it. So first, we have new 2023 exemption thresholds for Reg Z and Reg M. We have an update on the FDIC deposit insurance assessment rate. We have a blog post from CFPB on appraisals and OCC's 2023 operating plan, FinCEN's final beneficial ownership reporting rule, a court case addressing the HMDA reporting threshold, IRS retirement contribution increases for 2023, and then a FHFA announcement, two FHFA announcements related to Fannie and Freddie programs. All right, so with that summary of topics, we will jump into it. And our first item here is on slide 3, the 2023 exemption thresholds. And this is 3 increases to certain exemption thresholds, new for 2023. As we know, these thresholds are adjusted annually based on annual percentage increases to the Consumer Price Index. And we have 3 of them here for you, as seen on the slide, with the previous amount and the corresponding increase just to the right of the arrow denoting the increase. So the top one here on the top left of your slide is an exemption threshold from special appraisal requirements for HPMLs that is going from $28,500 to $31,000. Then right below that, we have truth in lending and the exempt transactions threshold, which will be increasing from $61,000 to $66,400. Both of these, of course, being implemented through Regulation Z. And then we have an increase to the threshold for exempt consumer leases, also going from $61,000 to $66,400. This, of course, being implemented through Regulation M. These are going to be effective on January 1 of 2023. So with those covered, I will turn it over to Heather for slide 4 here.
Thank you, Scott. Hello, everyone. We wanted to make sure that you were aware that FDIC has finalized their assessment as it relates to deposit insurance rates. This is something that the WBA filed a comment letter on here recently, just in the last couple months, actually trying to convince the FDIC that it was premature to increase financial institutions' rates that they pay for deposit insurance assessment. Well, unfortunately, sad news here. October 18th, the FDIC finalized their rule, finalized it as it was proposed. And so as a result, all deposit institutions, so all insured deposit institutions will see an increase in their deposit insurance assessment rate here beginning in 2023. So each institution will have a 2 basis points increase. It's going to affect or be based upon the deposits that you are holding from January through March of that being the first quarter of 2023. And you'll see an invoice then for the assessment for each bank to pay based upon those deposit bases. The invoice being due here in June 30th of 2023. So our role here at the WBA is to shift now to be monitoring that level of the deposit insurance fund and to advocate then on behalf of the membership that interest rate assessment needs to be reduced as quickly as we can after we hit the new threshold that FDIC is marching towards. So unfortunately, some sad news there, but wanted to make sure that it was on your radars that we're going to see an increase in the assessment rate. There is information related to this included in the link below as a part of this video. So with that, I'll turn it back over to Scott to take us through our next topic.
Sure thing. Thanks, Heather. So as mentioned in the summary, we have two items here related to appraisals and evaluations. And so some discussion within the agencies, supervisory approaches from the OCC, as well as some exam expectations that we're seeing here. And so not a new rule, but related to overall bank policy and procedures regarding appraisal evaluations, which is important here. And so the first item we have on slide 5 is actually a blog post that CFPB wrote regarding accurate appraisals. And in short, discussing the ability of a borrower to challenge an appraisal where the borrower believes it's inaccurate and to bring that to the lender's attention. And so the post discusses the importance just in general of having an accurate appraisal, both in terms of, over and under evaluation, where this is going to be significant to home ownership and mortgage lending. And again, overall, in order to avoid discrimination and any bias that might be present in the evaluation process. So what we're looking at here is a process by which, in the concept, really a concept whereby the borrower can come to the lender, approach the lender and ask that a reconsideration be made of the valuation. And what this is called then is a reconsideration of value, our ROV. And whereby the borrower can then, through that process, maybe point out some specific errors that they found, maybe if there's something that was left out or other omissions in the process, or just discrepancies in general through the evaluation. And the blog does give some insights on potential policy considerations. So we're looking at this as a concept where the borrower presents some issues that they have with it. And then, okay, how do we incorporate this into your policy? Where many of you maybe already have this in your policies and procedures or overall guidelines, but CFPB goes into what some procedures might be and what an ideal situation might be, what this would look like. So with your policies in place, and of course the interagency appraisal guidelines in mind, the blog post then goes on to discuss some additional benefits. So the benefit of providing borrowers with clear information up front, how the borrower can raise concerns about the accuracy of the appraisal. So really, we're talking transparency in the process, right? So how does the borrower know that they can confront this, or rather bring issues to mind, or bring questions to the lender's mind? Do they know that they can do that? What is the process that starts that look like? This might be included with copies of appraisals. So some banks might have that when you give out the actual appraisals that ECOA requires, that Reg B requires, or notices regarding appraisals worked into there, what your specific process might look like. Or even prior to getting the appraisal at all, there might be some separate or individual notice as well. This can vary, of course. Again, this isn't a rule. This isn't something that CFPB is issuing as a rule. This is within a blog post and something to consider. But the lender's reconsideration of that value process should be based on that opportunity to explain. And again, then the explanation that is given in the dialogue that has happened as to why the evaluation is believed to be inaccurate. Again, banks will have their own appraisal process and what is appropriate for that. It's something that is not incorporated into guidance, but is still a blog post that is worth looking at, worth checking, worth considering in contemplation of your existing appraisal and valuation policies. Wrapped into that, we also wanted to discuss OCC's Bank Supervision Operating Plan for 2023, which is what we have here for you now on slide 6. And you can see, among other things, that the appraisal is wrapped into their fair lending considerations. So among these other items that we have listed for you on the slide, OCC issues this annually based upon its fiscal year regarding supervisory strategies and priorities. So within that, We have OCC looking at the potential for mortgage lending discrimination resulting from potential appraisal bias or discriminatory property valuations. And this is worked into their fair lending conversation. So as a fair lending topic identified for examiners to look at and focus on. We've also heard from those of you going through FDIC exams where the examiners are looking at banks' process for similar situations. We know that fair lending as a topic overall is something that the examiners are focusing on. So now with CFPB's blog post identifying some potential issues, offering some considerations for policies, some process to consider, working with the borrower, that transparency, and OCC's supervisory approach. Again, take a look at your procedures. If you have an exam coming up as well, expect that this might be an area that they're going to look at. So again, I'll just mention again before turning over to Heather that there is more in OCC supervision operating plan in addition to that. So again, fair lending topic, the appraisal bias or discriminatory property evaluations as a potential concern. There is more within there, such as other topics of consumer compliance, discussion of safety and soundness, some BSA matters, and overall additional areas that examiners will be focusing on. So take a look at that from that perspective as well. Again, we have the link for this. You can see marked with the asterisk in the description of the video below. But with that, I will turn the topic over to Heather for a discussion on customer due diligence.
Super. Thanks, Scott. And just real quick before I jump into the FinCEN rule, just to add on to all the statements that Scott had mentioned, that to be clear, that when you do have an exam coming, I think you should expect really that you're going to have questions regarding appraisal bias. And so be prepared to explain your procedures to the examiners of how each institution, how you protect against there being, and how you help identify there being a concern if an appraisal comes in at a lower value. So really is an important concept that we're hearing about in exams. So moving on, as Scott said, to the FinCEN rule. So I guess the good thing is we have a final rule. So we have a final beneficial ownership reporting rule where entities will be filing information with FinCEN. It was recently published in the Federal Register here just past month, September 30th. You can find the link for this rule as part of this video. It is also within the compliance journal of this month. So you can find a short little write-up about that. We'll have a full-pledged article in November about the whole rule in the detail beyond this slide. But as far as a nutshell for the rule, it has an effective date of January 1 of 2024. So we do have a bit of a time here for implementation. FinCEN needs to finalize the actual filing of portal as well as the forms that are going to be used or electronic information to be used for filing. But with that deadline comes some actions that the companies are going to need to consider. That for those companies that are already in existence, they've already filed organization documents with the Secretary of State or here in Wisconsin with DFI, those companies will have a year to file initial reports with FinCEN. And for companies that are coming into existence after the effective date, those new companies will have 30 days after they have received notice of creation from Secretary of State or from DFI of the creation of the entity to file then the initial report with FinCEN. So that 2024 deadline or new effective date is an important trigger date. And so what the FinCEN rule requires, it's going to require entities to report information directly to FinCEN. And as is similar to other anti-money laundering rules, and underneath the world of BSA, there are information reporting about beneficial owners as it relates to each of those entities, as well as individuals who are filing applications for the creation of the entity. So beneficial owner, those are defined, it's a defined term, and we will, again, put forth those details in the forthcoming article next month. Beneficial owner reporting will be required for all entities going forward right from the get-go of the final rule. With respect to individuals who are filing applications or company application information, the rule says that for those companies that are in existence as of the effective date of the rule, those companies do not have to go back and file company information about those people that filed the application. That's going to be something that is shared that's prospective looking, that is required for brand new companies going forward. So the rule identifies who has to file documents. Basically, it's all entities. So corporations, LLCs, partnerships, those types of entities that are required to file with the state government in order to create itself. So here in Wisconsin, that would be any company filing with DFI to then be able to do business and create itself would need to be reporting to FinCEN. The final rule outlines what information needs to be included in the report. And again, that's very similar to what you see with other BSA filing requirements, where you identify who the beneficial owners are, you identify the names of those peoples, the date of birth of those peoples, the address of those individuals, and the taxpayer number for those individuals. So that's all clearly spelled out in the rule. There are more than one filing that needs to be done. There's an initial filing. There is a correction filing, if that's applicable. And there's also an update report that needs to be filed in the event that persons change or information changes and FinCEN needs that updated information. So each report has its own filing deadline that needs to be met for each of those reports. So stay tuned again on more information on that. This rule will apply to both companies that are created here in the United States, being domestic companies, as well as foreign companies created outside of the United States that are doing business here in Wisconsin or in the United States. There are a number of exempt entities that are not required to file. There's actually a substantial list, about 23 entities types are not required. We'll have that listing for you as well. But know that this rule is coming, and we'll have some more information more detailed information on that in the upcoming compliance journal. So with that, Scott, I will turn it back over to you. There's an important court case that Scott's going to run us through because it may impact your filings. Scott?
Yeah, so as Heather mentioned, we do have a court case for you here, a DC Circuit Court, in fact, which recently issued a ruling here invalidating the exemption threshold for reporting of closed-end data for HMDA loans. So there's a bit to unpack about that, so I want to kind of go through it step by step so we can understand what happened here, what it means, and kind of going forward, what the implications are. So this is specific to the 100 closed-end loans threshold, which would now fall back to fewer than 25 closed-end mortgage loans. But again, there's a bit more to this, though, and to kind of walk you through it step by step. Starting with HMDA. So we know HMDA reporting. We know we have HMDA reporting for covered loans. And CFPB, of course, has the authority to implement that through Regulation C. And part of that authority is the creation of thresholds for reporting, where a lender that does loans, which might be at or below that threshold, would be exempt from reporting requirements for certain loans. After determining that the existing rules, so what happened was CFPB, as part of this process, as part of this rulemaking, went through and did an evaluation of them. And after doing that evaluation, CFPB determined that the existing rules for reporting did in fact create an administrative burden on lending institutions. And so around the time of 2015, CFPB then issued a rule to exempt from reporting requirements those lending institutions that do 25 or fewer closed-end mortgage loans in each of the 2 preceding calendar years. Again, the idea being here that CFPB went through, did an analysis, part of evaluating the costs of the rule, decided that to alleviate some of that burden, it would create those thresholds. This was then later revised in 2017 and 2020, and CFPB again looked to address the burdens that are associated with HMDA reporting by setting the threshold now at 100 closed-end mortgage loans. So increasing that threshold for exempt institutions from 25 to 100 closed-end mortgage loans. Now, as an aside to that, the 2020 rule also set an exemption threshold for open-end lines of credit that was at 200, again, in each of the 2 preceding calendar years. So now, in this case that we have for you on the slide, again, a link to the case transcript in the video description below, the plaintiffs, a coalition of groups, did challenge CFPB's authority to set the exemption threshold under the 2020 rule, essentially stating that CFPB was wrong in its cost-benefit analysis. There's more to it, which the case gets into and the argument gets into, but in a super short summary, these groups commented throughout the process in CFPB's evaluation, looking at that, being critical of CFPB's cost-benefit analysis, and now brought this case where the court evaluated that argument and evaluated CFPB's cost-benefit analysis as part of that challenge. The court also, as part of that, then did go and agree with that argument. Again, finding here essentially that CFPB failed to properly support the increase that it made, that we just talked about, in the closed-end mortgage loan thresholds. So, as part of that finding, the court then invalidated the exemption threshold for closed-end loans and sent it back to CFPB. So invalidated that 100 threshold and sent this back to CFPB for further evaluation, further consideration. Now, what this means is that the exemption threshold for closed-end loans will roll back down from the 100 to the 25 that was set in 2015. So for 2023 reporting, you can expect that threshold will be determined at this lower threshold for 25 closed-end mortgage loans in each of the preceding 2 calendar years. To tie that together, again, as we talked about, okay, well, what about open-end lines of credit? Well, that wasn't what was at issue in this court case. So open-end lines of credit, not touched, not changed. That remains at 200. So again, keep that distinction in mind as well. Keep that implication in mind that we do expect for 2023 reporting that to change for closed-end down to the 25. And also, we can expect that CFPB will likely issue a new ruling here and instructions to follow for those of you who are affected. So we'll be watching for that. Keep your eye out for news from CFPB and an update from us as well. So with that summary of that court case and of those implications, we'll turn it back over to Heather to continue on with the rest of our presentation here.
Super. Thanks, Scott. Sorry for the delivery of that bad news there, but we do have banks in Wisconsin that have made more than 25 loans that were previously exempt. So we want to make sure that the word gets out to prepare for 2023. To help you with that, there's also a summary of the information that Scott just went through in this month's compliance journal. So if you want to read something more in detail, that's meant to try to flesh that out for you too. And feel free to call us if you've got questions on that. Also in our video here, as Scott has mentioned, we have the IRS contribution increase thresholds for retirement accounts as we move into planning for 2023. I think this gives all of our bankers a great opportunity to reach out to our IRA customers to make sure that they're aware of all of the thresholds which have gone up. So here on this slide, you will see that employees who are participating in the various types of retirement accounts, that being 401ks, the 403bs, the 457 programs, the participation levels have increased. That threshold now is 2,500, up from 20,000 last year. Also, from the IRA perspective, individuals now can contribute up to $6,500 into an IRA for themselves versus the $6,000 limit last year. For the few customers that have simple retirement accounts, that level has also increased, as have many of the different income ranges that are applicable to deduct contributions into IRAs, Roth IRAs, and then some of the other saver credit programs. All of that is listed in the information provided by the IRS in a link with this video, as is also a brand new technical guidance identified as Notice 2022-55 which includes all of the various cost of living adjustments that are helpful or necessary to know as it relates to pension plans and retirement related items. So for those of you in the HR area, in the IRA area, please be sure to check out this information from the IRS as you look forward for planning in 2023. So with that, Scott, you want to bring us home on the Fannie and Freddie information?
Yeah, sure thing. So as Heather said, we have our final slide of information here for you. The last item we have is actually two items. So two news releases from FHFA. We have an announcement for use of new credit score models by Fannie and Freddie and changes to guarantee pricing in each column here. So for the new credit score models on the left, FHFA has implemented FICO 10T and Vantage Score 4.0, which will be replacing the classic FICO. So FHFA expects that this will be a multi-year implementation, so we'll take some time to roll out. But after that, the requirement will be for lenders to deliver the new credit scores with each loan sold to Fannie and Freddie. Also, FHFA is looking to change the requirement to provide credit reports from all three of the nationwide CRAs. And instead, now what that means is that the secondary market would only require you to provide credit reports from two of the three. So that's what that final bullet point on the first column is for you, is a change from the current tri-merge system to now a bi-merge credit report. So then lastly, we also have the second news release for you here, changes to Fannie and Freddie's guarantee pricing by eliminating upfront fees for certain borrowers. You can see, again, under that second column, the targeted pricing changes to the Fannie and Freddie pricing framework. What we have are the programs and borrowers that FHFA will be eliminating the upfront fees for. So the elimination of upfront fees for the bullet points that are then listed in the slide. But the idea here in summary is to assist, as you'll see, first-time home buyers, low-income borrowers, and underserved communities. And the goal would be to implement this as soon as possible. And FHFA said in its news release that it will be looking to, in concert with Fannie and Freddie, of course, announce an implementation date soon. So keep an eye out for that. But with that, we will be looking to wrap up. So I'll turn it back over to Heather for some closing remarks to wrap up this month's presentation.
Super. Thanks, Scott. And as always, we want to make sure that all of you are aware of the various resources that Scott and I create for our membership, all available on the WBA website. There's a compliance-specific website landing page, and throughout the slides, you've seen an email address or a website address to find those. Please be sure to check those out. We add things to that every single month. For example, this month we have a new WMA reference chart. The October Compliance Journal has just been posted. Scott is currently working on a summary of the most frequently asked legal questions this past month. That'll be posted here in the next couple days. Any new ideas that you are looking for resources, reach out. We're happy to create what we can, but really is meant to be a landing place for you to find current information and additional resources. To be sure to check that out. All of the education information is also found on our website. One of the important items coming up on education is compliance forum. So November 15th, we look forward to seeing you in person up at the Dells at our second session of the compliance forum. The regulators, they're going to be back in person, first time since the pandemic. And I know with all of the different compliance items that are coming down the pike and what we're dealing with in exams, really is a great opportunity to hear and interact with those regulators firsthand, as well as to hear from your peers. So if you haven't yet signed up, be sure to do so. It's one of our best programs here in the compliance world. And stay tuned for more information in Compliance Forum from education to our Compliance Forum members, and then ourselves in writing compliance information for you. Also, don't hesitate to call us on the compliance hotline. Always happy to help answer your legal and compliance questions. Again, we are here to be your resource, talk you through topics such as the HMDA reporting threshold change and the recent releases by the CFPB. So with that, thanks again for listening. We look forward to seeing you in person here soon. Call us on the phones, and we'll see you again next month on another video.
Talk to you soon.